Okay, ladies and gentlemen, I think now we could start. Good evening, India. Good morning, Las Vegas. I'm delighted to welcome Dr. Vivek Sah to IIMA's webinar series today. This webinar is organized by IIM Ahmedabad's Research and Publications Office, headed by Professor Devjit Roy. Today's speaker, Dr. Vivek Sah, is a longtime friend. Vivek is also one of the 13 national level distinguished research fellows of NAIOP, which Vivek, and Vivek is a full professor at the Lee Business School, University of Nevada, Las Vegas, UNLV in short, where he also serves as the director of the Lee Center for Real Estate. There he leads policy-oriented research, forges strategic partnerships, and provides the community with a better understanding of Nevada real estate. Vivek's research focuses on REITs and housing, and his papers have been published in several globally leading real estate journals. Currently, he's a member of the board of directors of the American Real Estate Society, and I guess you're missing your meetings there, Vivek. Sorry to pull you here. And Vivek has earned several research awards internationally. Currently, the UNLV's expert on housing and real estate. He has been quoted in the NPR radio, the Wall Street Journal, and numerous local media outlets. The topic of his presentation today is steering consumers to affiliated financial services, evidence from mortgage pre-approvals and the cost of credit. Vivek, I must say that I found the whole paper to be quite provocative because I've always heard of steering with a negative connotation, but what you're showing here is perhaps the good side of steering. If attendees have questions, I request to post them in the chat window. I will post them to the presenter when appropriate. Vivek, the floor is yours.
Thank you, Prashant, and thank you everybody for, especially IMA, to give me this opportunity to present over here. Thank you for having me present some of the research that it's a recent paper that I finished and it's now under review. But it's a pretty interesting paper, and also special thanks to my friend Prashant for having me present over here. I think it's probably one of the first from the US in real estate to be presented at IMA. So I hope we can continue this series going forward and have a lot of international collaboration. Basically the idea is to get all the research active folks and others who are interested in real estate in India to see how research is being done, and also hopefully collaborate in some of the ventures using local data from India, actually, which would be, I think, a great step towards real estate papers being published using Indian data. Thank you once again. And just a brief background, I run the real estate program here at UNLV. I'm the director of the Lee Center, which is the only real estate center in the whole state of Nevada. We do a lot of things, including hosting events, conferences for the community over here. So, we have been expanding. We have industry-based research. And like I said, we have an undergraduate program that focuses on real estate. It was a real estate major and minor. We have around 42 students at the undergraduate level. And then we are looking to launch our certificate program in commercial real estate, finance, investments, and development for the community, which is kind of an abridged version of a master's program. So just a background, in terms of research of the last, I started out, my dissertation was behavioral real estate research. Then first few years of my academic career, I was mostly on REITs. And then I realized that getting REITs paper published in top real estate journal tends to be really, really an uphill task. So I kind of switched to something which is pretty, I would say, of common interest to economists, to finance people, and everybody else, and it's kind of more receptive to, the top real estate journals, especially the real estate economics and general real estate finance economics. So I switched to the housing side and been kind of lucky to have been able to publish over there. And then I've been going, focusing on housing. And so this is another of our papers on the housing side, but it's an interesting paper. I don't know about the results or the final outcome of the paper, where it ends, but I think the idea of the paper, the central idea of the paper as to how to use data and how to kind of take the data and answer that question, because this paper is so driven by how you analyze the data, as you may have, some of you may have read, is critical to the success of the paper, frankly. So the people who like it because the way we have looked at the data, the results may not be super interesting or super exciting, so to say, because it's how it is. But I think the core idea is pretty interesting, and this is one of the few papers, like I will mention, that starts to look at machine learning and its implementation on rules. So I'm going to share my screen here and start. And like Prashant said, you can ask me questions in the chat box, or Prashant can interrupt me. The paper, so I've just kind of changed a little bit of the title of the paper, just focusing on, instead of saying financial services, as stating residential real estate markets. So the agenda, we'll start with the motivation, what drove us, and what internal as well as external factors drove us, looked at the data analysis, and then what are the conclusions from this paper. So a little bit of the background. I know a lot of you know about what happened in the great financial crisis, 2007, 2008, starting with the boom in the mortgages industry, which started around 2004-5 with the lowering of interest rates and the pricing bubble in real estate. And Las Vegas actually was kind of the poster child of this whole crisis. We were ground zero, frankly speaking, of the great financial crisis. The whole industry over here, the economic base got decimated, and there was so much supply. At some point of time, we were having people buy multiple homes within days, and flipping was kind of at its peak. So this paper actually stems from the financial crisis and the aftermath of the financial crisis. So, the kind of entities that were involved in that, we had the secondary market entities that were kind of issuing these mortgage-backed securities, bundling of these. Of course, we had the role of the buyers and the borrowers who were buying property as if they were buying, I would say, not even common stock, they were buying groceries, right? Kind of walk into the bank, what we call as ninja loans, no income, no job or assets, without any kind of legitimate paperwork. They were getting loans again. So we had all of those, the profile of the borrowers and all of that went into that aspect. And of course, we had intermediaries in the transactions, both at the mortgage-backed securities level, which is the rating agencies that were manipulating the ratings to sell those bonds, the mortgage bond securities. The junk bonds were being sold as AAA rated or high A rated securities. So they had that role. And of course, there was a role of agents, which we'll talk about. And then you have the lenders and the banks that were issuing these mortgages and then making a huge profit because their bonuses were linked, which we saw how Bank of America kind of paid a humongous fine post that because they were issuing mortgages just because to increase their volume, and without having to bother about the ultimate risk, the default risk, which was being passed, which ultimately got passed to Fannie Mae, absorbed by the, by the federal government in terms of all the toxic assets that were transferred to them because they were kind of not necessarily, and a lot of people do not know that Fannie Mae is a private entity, government-sponsored enterprise, and it's listed. It means that they had nothing to do. It got privatized long time back, many decades ago, but people thought that it was their mandate to kind of absorb all the toxic assets. So that's the reason why banks or lenders were able to kind of push those loans, because they had no risk and they were just getting the commissions on these, so to say, risky mortgages. So in the aftermath of the great financial crisis, there was the meltdown. This watchdog, the Consumer Financial Protection Bureau, was created to protect consumers. And one of the mandate of the Consumer Financial Protection Bureau was to kind of look at all the notorious things that were going in the background to kind of steer consumers to toxic loans or toxic assets, so to say. The first head of the Consumer Financial Protection Bureau was Elizabeth Warren, who we all know ran for the president's post, and now is also being considered for some other things as well. So anyway, the Consumer Financial Protection Bureau was actually formed in early 2010s, and then they started getting to work to kind of go back and look into the great financial crisis to see what happened and how, in this case, steering was happening in the residential real estate markets. So in 2017, the Cfpb ordered Prospect Mortgage, which is one of the largest mortgage lenders in the United States, to pay a fine. It was not a big fine if you see the monetary value, around $3.5 million, but it was still a first step in terms of penalizing lenders who were kind of involved in what we call over here kickbacks to over 100 real estate brokers in exchange for mortgage referrals, which violates the RESPA Act, which is a real estate act, Protection Act, Real Estate Services Protection Act, which was kind of amended post the Dodd-Frank Act again, which was the Financial Big Reforms Act in 2008, 2009.
Many of the attendees here could not read the paper, so it will help if you could explain what steering is, so that.
Okay, so what happened in post the crisis is there are two ways of steering to look at steering. One is steering is when a real estate agent. So let me explain the whole process of how the service, the real estate selling services works, industry works over here, and typically true even in everywhere in the world, but in India, including India. So the multiple listing service, which is kind of a listing platform for all real estate agents in the industry across the country. It's a listing platform where they actually would list. They would list a property. So let's say if I'm a seller and I would like to sell my property, I will engage an agent who will list my property on the multiple listing service, which is seen by everybody in the system. The sellers, agents, the agents that are representing potential buyers, so everybody in that network, and they will see things over there, such as the basic characteristics of the house, but also there is a column over there that is private agent-to-agent remarks, which they will focus on in a bit. But that's where the agent tells the other agent something that is special about the property. Say, okay, do not go over there and take a look because there would be dogs over there. As an example, they might say, hey, this is a distressed asset and the lender requires X, Y, Z. So do not bring anybody who does not qualify. So that's an example. So what steering is when you actually, as the word says, when you actually take some of your customers and try to, in a very subtle way, show you properties that are probably going to benefit you, but may not necessarily benefit the buyer, because what you're doing is there is a back-end transaction that is happening, like I mentioned, kickbacks, where I'm getting more money or an incentive to take them to certain properties and not other properties, because I'm either getting kickbacks, which again violate laws, under the table, as we would say, or I'm getting a slightly larger bonus or a compensation tied to the successful sale of that property, in which case there would be potential repercussions for the prospective buyer, because they are not seeing all the properties that are out in their market, because and again, this happens because the agent has more information, private information, than the prospective buyer, right? So that's one. Steering has also been prevalent long back, especially targeting minority communities, especially African Americans, where we call this concept of redlining, where what happened was they were steered away from certain neighborhoods because those neighborhoods were affluent white neighborhoods, and these buyers were black, and even though they were affluent, they had the monetary economic background, and I would say they had the financial strength to buy these properties in these affluent markets, but because they didn't want the neighborhood to have African Americans or people of color, then they were steered away from these neighborhoods. So that's more on the transaction side. There's more on the lending side, which is what we will be focusing on. Does that make it clear, Prashant? Prashant, is that clear? Much more clear on steering? How does it happen?
Yes, thank you. Please go ahead.
Okay. So what happened in 2017 is Cfpb, like I said, they started working post 2017 and going back to see what's going on, and they did find Prospect Mortgage, which one of the largest lenders, to kind of were violating this RESPA Act. So what Cfpb discovered was the principal way the steering was happening, and that was kind of very, very unique, because before that they could not identify how steering was happening. So steering happens in residential markets by commonly known as writing in. So what like I was mentioning, the agent was doing in the agent-to-agent remark, they would say that the buyer is restricted in terms of the lending, which is only to specific institutions and not necessary to anybody. So if I am a buyer and there is a house that has that restriction, then what it says is that in order for me to buy the house or put an offer, I have to only qualify through a certain bank or certain set of lenders that the agent lists, and I cannot go to my own lender with whom I may have a relationship for from many years. So that kind of restricts me to divulge, of course, my financial information plus other things, to a specific lender. And of course, that what it means that I may or may not get the best rate, it may not be in my best interest. And that is what we are defining as an affiliated lender, because now the property, the for sale property is tied only to a lender and not necessarily to anybody else that I could get approval from, which means that despite my getting an approval from my own lender, now I have to seek another approval from this preferred lender. And if that does not qualify, they don't qualify me, then I kind of don't, I can't bid on that property. So that's what we are going to focus on these properties where we have these constraints on the lending side. And that's what the motivation is. How does this kind of restrictions affect the outcome of the borrower, prospective borrower, in terms of the mortgage instruments, and if at all that spills over to the asset, and that's the motivation of this property. So this will give you an example of a listing sheet, MLS listing sheet, what buyers see. So as you can see, this is, it is typical It'll give you all that information over here.
Okay, Vivek, we have a question. So
Yeah.
what is the role of the seller here? Can the broker restrict the showing of property at the detriment of the seller?
Yes, so that will happen if the if you have somebody who probably, we don't know, right, may end up bidding higher for some reason, but does not qualify from the lender's perspective. So it may adversely impact the seller because you may have a prospective buyers that may end up bidding high up the property, but are restricted now because the lender wants them to qualify through that lender, not their own lender. So it may have adverse consequences from a seller in terms of pricing of the asset. Yes. So again, this is an example of a listing service. So this is what an agency, so this is kind of very descriptive in terms of the sheet that they get, in terms of what they would, what the property will have, the kind of information. As you can see, it's pretty exhaustive as what all information there is. So now we want to focus on these private.
Sorry, you're going to explain it. Sorry, go ahead.
Yeah, so now we're going to look at these private remarks that the agents put in. So these are the agents' remarks we're staring at: to bank-owned property being sold as in condition, and this is verbatim. This is directly from MLS listing on the private. Again, this the only people who see this is the seller's agent and the buyer's agent. We as a seller, we as a prospective buyers do not see it because this is a private listing service only accessible to the seller's agent and the buyer's agent, and seller and us do not see that, despite even if we have Zillow and all that, may not have that information. So it says all offers must be submitted. So the thing that I have pointed out in in red, written in red, that's the that kind of signals steering, right? So all offers must be submitted with a pre-qualification letter from Bank of America Homes. Saul Goodman at time of offer used this. So basically now, if let's say I'm a buyer, I like this property, but I don't want to go to America Home Loans. I don't want to take that, that offer, American Home Loans offer, because I have my own lender. Why would I go there? So now, if I'm desperate to buy this property, I have no choice. So that in itself is violating the law, because now I am now restricted to this American Home Loans, and I may not get the best deal. Ex ante, that's the ex ante expectations. So again, this is example. So again, please have your buyer pre-qualify with Saul Goodman. Okay, that's another example of. So now they are kind of directing us to go to Saul Goodman, who could be a mortgage broker, who could be a lender, a loan officer with a particular company.
And this information does not show up on the public MLS, right? It only goes
This does not show up in the MLS. And again, MLS is, we cannot say it's public MLS, because I and you and anybody else do not have access to MLS. I mean, we can go and get, but you have to be a registered agent and all that to get access. And by the way, MLS is now operated by CoreLogic. They bought them many years ago. So yes, it's a database management system kind of that. So those people do not have access to it. Those who are outside the system, only the buyer, all the brokers, all the agents in the system have access to it. So now this is an example of the complaint, Cfpb steering complaints by a buyer in Texas. And so Cfpb is pretty user-friendly website. They look at any kind of scam, be it in the mortgage, but the mortgage industry was where they initially started because it was rampant leading up to the financial crisis. So they focused on those, and then that was the kind of the niche they had at that time, and now they have expanded to all kinds of, including phone scams, any kind of scams on senior citizens, all of that. And you can go on their website, file a complaint, upload the documents, and they will investigate that. So I was informed that if I use the preference, I would receive credit towards my loan. The seller did not grant me credit, so I'm being forced to continue the process, or I'll be sued for commissions. Okay, so this is a complaint, a legitimate complaint that Cfpb had. Somebody registered the complaint. They kind of investigated that. So again, this is another one. We decided to go with Wilfau, even a point to go with them. My own employer, I work at a big national bank that offered me the same rate. So again, here, they were forced to go to Wells Fargo. So I mean, so yeah, we decided to go even on the opposite with my own employer. So again, this is now targeting a specific bank, despite the borrower who is financially literate in this case. So it's not just anybody there, it's not specific people they're targeting everybody. So again, the complaint you can see over here. Again, we got an approval. We later found out the only way listing will accept the buyer's offer if you listing agent's preferred lender. So all these complaints, and there are many such complaints. So why is it relevant? I think leading up to the financial crisis, it's such a big, opaque black box in the real estate world, because we do not know what's going on. What are the conversation my agent, the seller's agent, and the buyer's agents are having in the background, how they are colluding, so to say, with lenders or specific, mortgage brokers. Because at the end of the day, what matters is what is their incentive, right? And how much money they are getting. And this could be in kickbacks. We don't know what's going on over there. If they're getting a special bonus for taking the borrower / buyer to a particular lender, because it's a competitive market. It's not that you just have one bank or one mortgage lender or a broker. There's so many of those. So it's a very, very big industry, and it's pretty evident that there are things that are going on that the buyer and the borrower do not know of. And there could be, there is some anecdotal evidence of efficiency gains for some market participants, which could benefit some people. And we also wanted to understand if write-ins lead to product loan steering market capture, which means that how many of those loans that were steered actually end up being underwritten or being approved by that bank. So it may not happen all the time, because I may say, no, you know what, I'm not going to go there, or I'm kind of go there, and now I as a prospective borrower have been converted or captured by that lender. So you're going to see how much of that happened. So the two research questions, broad research questions, we are trying to answer here: how prevalent is financial steering, and then how does financial steering affect market outcomes for the entities involved in the housing market, but specifically focusing on the lending side, which is the borrower's mortgage outcomes. That's the specific goal here. Any questions, Prashant, or should I keep going?
We're good.
Okay, thanks. So what is at stake? We have the buyer, we have the seller, we have the listing agent, and we have the lender, right? So there are supply constraints for the buyer. They have different borrowing costs. Seller have fewer buyers now because, we kind of restricted certain people because of the write-in, so to say. And of course, that may be a positive outcome, because now you are kind of, I would say, screening people who otherwise may not qualify, right? Because we know, at least in the US, we have started a lot of people who are just shopping, window shopping, so to say. They'll just go there. They really don't want to buy. So kind of not wasting everybody's time in terms of showing the house and the seller getting excited, oh, I have so many buyers. So that's kind of misleading. So now we are with that we may end up having only people who are very interested and who are okay with getting underwritten or pre-approved by another specific lender other than theirs. And for the listing agents, it's probably higher, we would say higher expected revenues over time, because now the chances of an unsuccessful, because these are success-based compensation, right, for all the agents. So now he knows or she knows that it is now going to be only people who are okay with that, but now are very, very interested in this property. So again, kind of acts as a screening mechanism, filtering process. And lastly, for a lender, and we are talking about risk mitigation, because lender might say, you know what, if there are people who are qualifying, maybe they're getting, because the thing what happens is pre-qualification is not a very, very strong kind of process to get these people approved. A lot of times the pre-approval, which is just a lender saying, yes, this person looks okay. They have not done extensive, due diligence on them. So they look okay, which means that we will fund them, but not necessarily. So it's a very soft approval. So a lot of those soft may not actually, when it actually goes through the whole underwriting process, when the bid has been accepted to get to the final approval, actually do not end up qualifying for the final approval. So it's a risk mitigation. And then from a lender side, because we are going to focus on, which I'm going to talk about in the data section, on properties that were actually distressed, it results in an asset sale, a successful asset sale. So these are all the things that are stated for different entities that are involved in this process: the buyer, the seller, buyer also / borrower, seller, listing agents, and the lender. So contributions. So it's probably one of the first empirical account of prevalence of steering borrowers to financial services on the lending side. So across the literature, there have been papers, but again, very, very few scant papers right now that look at that, look at steering borrowers. And on the real estate side, again, on steering, there's been almost maybe a few, 2 or 3, but very, very limited. And like I said, excuse me, one of the first studies in the real estate literature to utilize machine learning to read contextual data. And it also explores aspect of Dodd-Frank that regulated post-market great financial crisis, in particular, the role of Cfpb in penalizing people who violated rules and regulations, who were getting kickbacks, and setting the standard in the industry, or rather correcting the standard to make sure that these things do not happen and lenders do not benefit from such activities. So preview of results, steered mortgages account for about 55% of all mortgages on bank-sold properties in Las Vegas metropolitan statistic area in our sample period. Ex ante, we had expected adverse consequences, adverse effects on borrower mortgage rates. On the contrary, we do find steering actually results in a positive outcome and ends up lowering the contract interest rate by about 2 basis points and if you kind of convert that to an economic value, that's around $200 to $300 of saving on average conventional loan. Steering could reduce the financial burden on borrowers by 6%. Again, this is in relative to their overall financial cost, which is between, I would say, I think $3,000 to $4,000 in terms of the underwriting cost, loan origination, and everything. We find no evidence that steering increases the contract rates for particular demographic groups of borrowers. That's basically what it means, that when we look at specific demographics of the borrowers, it's because there have been evidence that that there have been an adverse effect on certain minority borrowers, especially Hispanics and African Americans, who have been steered to high cost loans. And we saw that during the Great Financial Crisis, that the most of the borrowers, and again, it is related to FICO scores and the credit scores and income, but there was evidence that these people who got high interest rate loans, especially the subprime loans, tended to be minority borrowers. Lenders who steer are substantially more likely to finance a transaction that lenders do not steer borrowers. So, we do see some of that evidence as well. So the related literature, broken it down to the agent steering and loan product steering. And I'm not spend much time over there because there's been a lot of evidence that that had looked at agent steering, which I mentioned, how when agents represent both buyer and seller, how it creates conflicts of interest. There's been this famous study that was also part of a book where Levitt did that. And it was when agents sell their own homes versus clients' home, they found that the agent's home was selling at much more higher at premium. So basically, there is some informational advantage that agents have in selling their home versus the client's home. So that's kind of steering. And then there has been evidence that in multiple listing services, because these are all commission-based, they do mention how much commission each agent is going to get. So agents, when they look at that multiple listing service and see properties that have been listed for sale and offering lower commissions, they tend to steer their buyers away from there because they know that they're going to, their commission is, let's say 2% as compared to 2.5% in others. So they will steer them, their prospective buyers away from these listings that do not have a higher commission as compared to others, which basically means that now the buyer is not having a look at all the properties, even though if it fits their criteria, because it's being steered away because the compensation of the agent is being affected. And of course, there's been recent
we have two questions. I think they're relevant at this moment.
Yes, please.
Venki is asking, are you looking at total cost to the borrower or just the rate? And are there other benefits that lenders get, like ease of securitization?
Okay, so that's a great question. The first one, we are looking right now only at the cost of borrowing as reflected by the interest rate. We are not looking at the other costs. The reason for that is purely linked to the availability of data. Getting interest rate is easier access as compared to getting all the rate, which is one of our, it's kind of the, further research towards the end. I talk about that because that is probably a better question because, you may have the same interest rate or even lower, but the banks are making more money over there because banks, that's how they make the money because they're going to pass that rate to.
Yeah, but I guess Venki has an interesting point here, Vivek, because even if for a subsample of data, you could run the effective borrowing cost or APR.
We did that, yeah.
Initial friction cost. I think that would be worth doing with the resources you got. Yeah,
we did that. The problem with that, like I said, is we do not have the whole sample of the data. The data is very sketchy. So we looked at APR, but it was not, not all banks list their APR in the data that we were able to get from CoreLogic. Again, our source of the data, which I'll talk about, is CoreLogic. We do not get that. But I agree 100%, and that's why I'm saying this is the biggest constraint of this paper is we do not look at those costs as reflected in the APR, or if you could get the direct other cost, which is only available through certain entities. And I think the cost that we found out for that, for our sample, was around $10,000. So if I am Bangalore or Venki has $10,000, definitely we look at that and have that, but that's very relevant.
We have another question, and it's interesting. What role does Cfpb play in the MLS process? Does it have any role?
In what?
Does Cfpb have any role in the MLS business? Do they regulate?
No, they don't. They're a security watchdog, just like the Security Exchange Commission, and they don't have on the MLS side. they only have when somebody complains, and they will look into those. But like I said, they did look into how steering was happening through this MLS system, because they got access to the MLS system, and then they started looking how these steering was being written in, and they were able to identify potential loans that were steered, or potential transaction that was steered. So they did look at that. I mean, they have access to it. They can get access to it, and that's how they were able to identify.
Devarpita is asking what effective borrowing cost is. Maybe I could take a lead. So Devarpita, yes. When a lender gives a loan, they quote an interest rate, which is only the contract rate. But on the top of that, they also slam some fees. So when you also include those fees in the cost of borrowing, it becomes higher than the contract rate and the interest rate. So that is the effective borrowing cost. Please go ahead, Vivek. We have around I would say 20 more minutes.
Yeah, thank you. So again, then the other aspect is loan product steering, and there have been some papers that have looked at how, how some borrowers, despite they having high FICO score, were kind of steered towards subprime loans, because subprime loans tend to have higher closing costs that go directly to the lender or the originator as fee. So there has been evidence that there were people who have high FICO score, but they were steered towards these subprime loans because they were more incentives for them to, the bank who had more incentives. And then, of course, there is some evidence of Agarwal found out that they were directing rejected borrowers to high rate mortgages, especially when they were looking at home builders that had affiliated lending arms. So there was some kind of back-end communication where the rejected borrowers were steered towards their own lending arm, which resulted in a successful sale of the property through the home builder, but they benefited both on the asset side, but also on the lending side, because they were targeting those specific borrowers who were rejected by other lenders, and they ended up with their own bank or lender and high cost. So our data, it's like I said, the data, the sources is MLS database, the core logic, which we had to pay some few $1,000s to get that data, because they are the largest curator of such data in the country. So you can buy those. Anybody can buy it at a cheap discount. A cheap rate and discounted rate. Nevada Real Estate Division, which has all the license record of all the broker related information. And then HMDA, which is Home Mortgage Disclosures Act, which basically is an act where banks have to capture borrower profile in terms of demographics. And that data is publicly available. The only problem with that data is a little bit sketchy. And then the borrower is not identified. So you have to do a matching algorithm to match the HMDA data with your transactions data, which is pretty cool, because in some markets, you may come up with a match of 80%. In our case, our match was around 30 to 40%. So depending upon what market you have, the HMDA data, which is public data, you can match that of borrower's profile, demographic information with the transaction based on certain key identifiers, because you do not have the name, so you cannot match. You don't have the property name. So the two parameters that you use is date of closing and loan amount and LTV. Those are three identifiers that you try to match using an algorithm program with your data. And in some cases, in the transaction data, in some cases, the overlap or the match is 60 to 70%. In some cases, it's much. It's a hit and miss. Our time frame is 2008 quarter 2 to 2018 quarter 1. We focus on certain, or not all the whole sample of properties. We just focus on bank-owned transactions. So single-family condominium, bank-owned transactions which are distressed, basically distressed assets. So this is our sample, and we do have some. We exclude flips and other things. So the machine learning cycle, which is how do we use the machine learning, cycle and kind of program use this to program to find out which data is, or which data point is relevant, which of them is steering and which is not. So the whole cycle is you start with a basic premise, you collect the data, you train the algorithm, and then try it out with a sample, and then provide the feedback to the program, and then it uses the feedback to fine tune it. And then we have multiple iterations of this till we come to a confidence level where we know that the output is what we want with a level of, with a confidence level. So we do this, I think we repeated this 8 to 10 times with our machine learning software that we use. And we, in our case, to identify financial steering in our sample, we use IBM's Watson Natural Language Classifier. We did not have somebody program it, because it's, if you have somebody who's a great programmer, especially on the computer science side, the computer engineers, they do that all the time, they can actually come up with a program. But we outsource this to IBM's Watson. You know, it's Watson has proven to be very, very smart naturally. So we use IBM Watson's natural language classifier. They have a program where you pay them 20 cents for each transaction, or 5 cents, I don't remember. And they will go through all the data and then kind of work with us to fine tune that to get your desired output. So we begin by building a training sample. We classify by hand 600 random samples, and then identify those as steering and not steering, and feed those to Watson, and then Watson then have Watson code those, and then we correct those, go back. So it was computer us, and we kind of repeat that till we reach a confidence level, and we then find that that Watson was able, Watson's classification strategy was up to our level of expectations. And we test Watson and randomly test Watson and find its accuracy level to be above 98% in terms of identifying hard ask and soft ask, which I will explain how this is. So these are on the left-hand side, as you can see, you have these agent remarks, and then you have the probability scores of steering and not steering. And then our confidence level was 98 and above. And then we put them also in buckets. So our hard asks were above a certain threshold, and then everything else was a soft ask or not steering. So this is how Watson identified it, which is on your right-hand side. So this this is a share of,
question. Is there a possibility, like in the previous slide, that like in the first example, they are being asked to go to solve
Goodman.
What if the prospective buyer's pre-approval is with the same lender as well?
Yeah, there could be some overlap over there. We didn't look into those. We only looked at, so we took those out. We looked at those that were not overlapping. So, you know, different pre-approval and different your preferred lender.
Mm-hmm.
So this is your share of shared mortgage origination. As you can see, it peaked in 2012 at almost 70%, and the average is around 52%. And kind of gone down, you know, especially after the Cfpb started acting and looking into these. So our baseline
Vivek,
model.
Vasumati had a question about how big is this steering, and I guess this slide gives an answer to that, right? So she's asking how big steering is, and does it have the potential to influence the whole lending process? She works for one of the leading U.S. mortgage companies.
Yeah, so it's 70%, as you can see in 2012. That was share of mortgages of bank on bank sold properties.
And when did CFPB come up with, was it, there was an act that...
Yes, so 2013 CFPB was formed, if I'm not mistaken, exactly here. And then they started doing all those. And like I mentioned in my previous slide over here, the first big case breakthrough they had was in 2017. So they, from 2013, they started and then falling. 2017.
Mm-hmm. Right.
Yeah.
Interesting.
Yeah. So this is our baseline model where the dependent variable is the mortgage outcomes, and then we have a bunch of controls in terms of the basic, controls on the subdivision, lender fixed effect, listing agents fixed effects, and then we have a vector X for controlling for the neighborhood, for the property characteristics, basically. And then our variable of interest is steering, which is a binary variable 0 and 1. Like I said, we have various controls in different models to test our hypothesis. Again, this is again an example of some of the hard as, soft as. So this is how they were, classified by Watson: hard ask, soft ask. So as you can see, one thing that comes out over here, you can see is buyer must be pre-qualified. That word must makes it a hard ask, which means that they have no option over there. The other hand, when you're talking about a soft ask, you can see that you are looking at please consider, okay? And then of course neutral, which Watson could not identify, is call listing agent because you don't know, right? And then unknown is where Watson could not understand whether it's a soft ask, hard ask, or neutral. And then we put them in different buckets. C1 as 99.5, C2, those are the probability of it being assigned, soft, hard ask, soft ask, and neutral. And these are basically, a distribution of Watson's accuracy at identifying steering, and this is in the paper as well.
Question, clarificatory. Devarpita is asking, how are you defining the dependent variable or the mortgage outcome? I guess that's what you're asking, Devarpita, right?
Yeah, so the mortgage outcome, primarily our of interest, a variable of interest is the mortgage interest rate. And like was discussed previously, to answer the question that Venki had, was that we should look at others, which is great because then you would have that, but also break it down in the terms of cost. So ideally we should have the mortgage cost, which we analyze, measured by the interest rate. We should do an APR if we have that data, and we should look at the closing cost, which is significant in the U.S., typically between averaging $5,000 $6,000 on a I would say 300 to 400,000, and up from there to maybe 600, 700, and then kind of goes up a little bit. But that's key because you may not find a difference in the contract interest rate, but significant differences in those, because that's where the bank makes money. Because if we know that these loans are passed on to into the secondary mortgages market and being absorbed by Fannie Mae. But again, that's more of a data-related issue right now. So Watson hard ask score, again, this is distribution. So again, a little bit on how what kind of share of the observations in our sample. Again, I'll kind of skip that because it's in the paper. But again, what we're trying to show over here is that Watson did a great job and identified the hard ask, and it was very accurate in those. So our threshold is very high. And of course, as we decrease that confidence level, then of course your observations will go up, but then the clarity in terms of whether it's steering or not goes down. So that's a trade-off, and we would like to keep that much higher. And look at only those that we are sure of steering, otherwise it kind of muddles the data. So this is basically a spatial distribution of bank-owned listing steering borrowers. So as you can see how this is across the sample. And this is our mortgage summary of, and again, this probably won't make sense to you. Basically what it says, it's not concentrated in particular area, because then it would be questionable. But now it's kind of very geographically distributed and not focused on certain neighborhoods.
There's a suggestion here from Venki. Do brokers steer all listings during a particular period, or is there a selection bias in the sample?
Selection bias in terms of what? Because we did control for broker characteristics. So it depends upon what kind of selection bias you're talking about. If they're linked to brokers' characteristics, then we control that. If we look for borrowers' characteristics, we also control all of that.
Okay. So 91% mean LTV, that's quite high, because this also includes GFC time mortgages, right?
Yeah. That's why, I mean, it's pretty highly leveraged. So that's why these are distressed properties, right? So there's correlation between distressed properties and LTV.
Makes sense.
And again, these are mortgage characteristics, you know, distribution between steering and non-steering. I don't know how much time you want me to spend on these. How much time do I have, Prashant?
You have 10 more minutes.
Okay.
So a lot of these differences are significant, right?
Yeah.
So
yeah.
there could possibly be some kind of a selection bias, right? In terms of at least mortgage characteristics.
Yeah. So again, but we control for all of that when we, in our model,
Right.
as I'll show, again, these are on borrower characteristics, difference in some aspects, differences in not in others. So we do control in our equation for all of those. And this is property related characteristics. As you can say, there's difference in terms of the asset as well. And then these are the, you know, broker characteristics. So there is some difference over there as well. So now this is our results for the first set of controls. As you can see, 1, 2, 3, 4, 5, 6, all the way. We keep adding year, month fixed effects. Then we add listing agent fixed effects, lender fixed effects in terms of the profile of the lender. And then we have subdivision fixed effects because we are able to identify in our sample these subdivisions, because these tends to be very different. So we have control for that. And in our sixth column over there, we also do a propensity score matching. What we do is for every steered mortgage, we find another mortgage in the same subdivision or close by that matches all the characteristics of the asset. All right. And so then run that model.
This is your selection bias control, right? So you're already doing that.
Yes. So on that, we are, like I said, we add those, but we're also doing those propensity score matching, which kind of control for any kind of selection bias that is there in terms of the asset as well. So as you can see, the direction of steering is consistent across and significant across all our models and controls. But the
sorry, Vivek, but to build further on Venki's point, so here the propensity score is purely based on asset characteristics, and the steering significance has gone down. So is there a possibility that if you strengthen the PS matching, maybe the steering variable could be rendered insignificant? Because that could be an interesting finding as well.
What's that, Venki?
So, so with propensity score matching, the steering significance has fallen, right?
Yeah.
So if this propensity characteristics, the set of characteristics are even larger, then perhaps you could show that steering is not there at all, right?
Well, that again depends. So for our propensity score matching, I have to go back. We kind of went to the most that we can match. And again, you know, there's certain variables that you can match, and then there's certain you cannot. So of course, I mean, can you increase the sample? But again, we are restricted in terms of the sample that we have in terms of the transactions that our bank sold and then matching those. So I don't know how much latitude we have in terms of increasing our variables on which we match the sample. But that's a possibility, definitely. But I just don't know how far we can go, you know, in terms of adding extra variables to further that that model. Because at the end of the day, any propensity scoring model, you know, you are constrained by the number of variables you can match, right?
Right. Yeah.
So, but basically we looked at, we tried to find exact as much as possible, the same in terms of the asset.
Mm-hmm.
Now we look at, so here our dependent variable was percentage rate. Here we add other variables like loan amount, loan to value, whether it's a type of mortgage, fixed rate versus variable, kind of loan, whether it's piggyback loan, otherwise, whether it's an insured loan versus not. So we add, but again, the results are not significant in most cases. So we did not find any other characteristic impacting steering. I mean, the impact of steering on these other specific type in terms of certain subset of mortgages, steering prevalent in such kind of mortgages. Then we have add, the dependent variable is income. We look at female, Hispanic, African American, add those to see if there has been some targeted groups, demographics. And then we do find that the Hispanic was negative. So they do, the steering was more towards a particular demographic, which was Hispanic. However, it ended up actually benefiting that group in terms of having a slightly lower cost of borrowing as compared to others. So we did find a positive influence as compared to other results in the past. They have found that they end up paying higher interest rate, especially African Americans. So we did find something.
So this data is it Las Vegas data?
This is Las Vegas data, yeah.
So yeah, I think this could warrant some more explanation. It's perhaps because there is a larger proportion of Hispanics in that area, or maybe this is an interesting finding because it's not African Americans, it's not female, it's Hispanics. And I think this is an interesting finding. There could be something.
Yeah, and if you look at the observations, I mean, I think it was not necessarily skewed towards a particular group in terms of the distribution. I think it was kind of evenly distributed. If you look at and we're talking about Vegas population. So Vegas population, if I was to look at, which probably, and I will not look probably, I would say 15 to 20% maybe Hispanics. I'm not sure of that, but again, it could be. It's around that, but the distribution of it is kind of not highly skewed towards one particular. And then we looked at the profile. So we added co-borrower, whether the co-borrower was female, whether the borrower was female, and all of those. And this is all HMDA data. And again, Prashant, to be fair, the HMDA data is, like I said, how much match you get with your sample. I have known people in other markets where their HMDA data is so clean that when they match it with the transaction data, the matching is up to 70%. In our case, we were able to reach 30 to 40% matching when we are matching HMDA data, which is publicly available to our private transactions data based on certain variables, which was, like I mentioned, loan to value, closing date, and loan amount. So that's how we take those variables and try to match those samples so that the loan variable data or profile data, demographics data is matched to the transactions data. And again, in some markets, it's much better than others. So we do find there's some evidence in terms of rate, and that rate tends to be lower for Hispanic borrowers, which is kind of, further to the previous slide or previous results. Now, this is interesting because now we're trying to find out how much of the steering actually results in capture, or how much of the steering actually results in business for the bank that was the preferred lender. And we do find, as you can see in column 1 and 2, find evidence that the capture rate is significant, and kind of almost 14 to 15% of the steering actually results, of all the steered, 14 to 15% actually results in capture, business capture. That means the final approval lender is actually the lender that is in the steering right in. So this is kind of significant because that means that they're benefiting from the business in this whole process. And the last thing we did, which was an added, we have looked at the borrowers, interest rate and borrowers' mortgage outcomes. We also look at the price of the asset as if there is a significant effect on the market outcome of the asset in terms of pricing, and we do not find any evidence that steered mortgages or steered properties have any different price than non-steered mortgages or transactions. So in conclusion, mortgage transaction between borrowers and lenders, it tends to be an opaque process. We don't know what's going on, how borrowers are being steered into particular transactions, specifically in terms of mortgages. And the aftermath of the great financial crisis, and we know that the Cfpb has done a great job leading to more transparency. And this paper offers a unique method to identify such kind of financial steering using artificial intelligence and kind of classify them as to what is steering and what is not. And we do find that steering was prevalent and continues to reflect a presence in the Las Vegas housing market. And we do know that steering listing mostly affects distressed asset, as banks want to control that process, which is kind of natural, right? They want to control that process, and hence the outcome to reduce the default risk. Because if you're selling, if you are a bank, you have bank-owned property, you are the bank, you want to make sure that the next person who buys it is solid and is profile as a borrower does not lead to another distressed asset down the road and in terms of default risk. So they want to mitigate their risk and reduce their default risk down the road. So who hurts and who benefits? On average, steering does not seem to increase the cost of borrowing, at least in terms of the rate of interest. If we get data on the, again, which is subsequent, if we can get some funding, as to look at the cost of borrowing in terms of the closing cost, then that would be kind of a complete evidence in terms of how steering in the residential real estate markets affects the borrower across all parameters. And we do find that steering borrowers pay 2 basis points less than non-steering borrowers. In terms of pure numbers, it's the not big economic value, but if in terms of percentage of their overall financial cost, it is substantial, I would say. The lender, the lender eventually gets the business, and it's basically motivating the borrower to switch lenders and have a slightly economic benefit in terms of a lower interest rate. Steering may also, in this whole process, nudge them to kind of compare loan terms across multiple lenders and financially benefit them, because you may never know. In this case, at least we know that the steered lender is actually benefiting them in terms of better interest rate. However, steering also allows lenders to undercut competition and eliminate competition, which results in kind of the capture rate that we talked about, around 14%, which helps their business in terms of the volume. So this basically gives you an idea. I know somebody was asking, so you can see the conversion rate statistics over here. Conversion rate was almost 30% in some cases. For Wells Fargo was 23%. Countrywide Bank was 28%. So it kind of an average is around 22%, which is kind of significant in terms of capturing the borrower through these steered mortgages. So in conclusion, regulators face a trade-off, when deciding whether to or how to regulate steering in mortgage market, because it's not healthy, but again, it is helping in terms of competition, it's not healthy, but in the end, it's helping the borrower. And like Venki mentioned and others too, then additional scrutiny on cost of mortgage of steered buyers, data constraints, like I said in this one paper, and then looking deeper into other markets to see if we can find evidence where we have higher, I would say, the HMDA data matching as compared to ours, which was just 40%. There's some market that's higher that will kind of increase the uh, the the demographics and the data in terms of the quality of data, and we may be able to get better and more robust results. And that's pretty much it in terms of my paper. But thank you so much for listening. I think almost an hour and 15 minutes. So I hope it was not too boring. And I know there were some areas that would probably require more attention.
Yes. Vivek, I don't see any questions, but Ashish, you had something to say. Would you like to unmute yourself? Venki had to leave, so he left a note. Anyway, so if no one else has a question, I would say, Vivek, this was a fantastic paper. You know, it's the hypothesis is provocative. Your findings are significant, and I see. So, anyone who wants to say something? Okay, so
objective behind
is asking what is the objective behind steering, and is it market capture?
Well, I think it is, but as a lender, it's also to make sure you mitigate risk, because these are bank sold properties. I have to reiterate, this is bank sold property, so it's in the best interest that this property has already gone through this one distress, at least. Now we want to make sure that it does not go through. As a lender, I'll be worried. So I want to make sure that the underwriting by me or any lender, I do not trust any other lender. So not only I'm capturing that market and the consumer or a customer, sorry, but I'm also making sure is that my underwriting standards are much higher and the underwriting is robust, so that I don't have to go through this again because lenders don't want it.
Right, and Deva says it does make sense to do so. Yeah. My 2 cents would be not to position this paper against Agarwal's paper, because their steering is a very different kind of steering. Like traditionally, steering is more demographic, and here it's like Deva suggested, it's a nudge. And is it really unethical? We don't know, because in India, many builders do it all the time. When you go and buy a property, they also recommend a lender, for example. So is it steering
versus forcing them to qualify is different. Yeah. So this is, they said you must, right? So that's why these are hard asks. And I know Ashish was asking something over here. How did you identify in which cases have steering instance? So that's the whole thing, is we trained Watson to identify. So this is basically contextual data analysis. So we train machine learning to that, train the Watson. And people may not use Watson. You can have a programmer who can program all of this to identify which is steering. And that was the whole thing, is we're talking about those 98%, 99% confidence level, where it was hard ask versus soft ask versus neutral versus unknown.
Mm-hmm. So Vivek, as much as we would like to continue this discussion, this is dinner time for people here. And some of them have already left for dinner. On behalf of IIM Ahmedabad and the whole community that is present here, we would like to thank you for a wonderful presentation. We hope to bring you back here. And the audience, thank you very much for your wonderful questions and discussions. We hope to continue this real estate webinar, so stay tuned. We will have more coming in, and hopefully Vivek will come back as well.
I just want to say thank you, Prashant. Mm-hmm. I just want to say thank you before you sign off. Thank you to you, especially for arranging this first of these series, and the whole team at IIM Ahmedabad for giving me this opportunity to present again in front of this wonderful audience and this great school. And I look forward to further collaboration with the school and yourself. Thank you so much.
Thank you, everyone.